Steph, a comment quickly from you on IBM, which you were just trimming in recent days.
From what I see, it looks like it was pretty good in terms of demand across the board. Software up 6%, consulting up 10%. That's a little bit better. Infrastructure also up 19%. So total revenues, earnings, and revenues beat. The thing I think people are focused on, well, A, was gross margins, which came in better than expected at 56.2%. People are looking for like 56-ish. And the other thing is free cash flow. So they're lowering the guide for free cash flow, just the range. From 10 to 10.5 billion was the range. They're going to 10 for the full year. But that is entirely because of currency. And also they exited the Russian business. I think this is a solid report. If it's weak, I'll buy what I sold last week.
Oh, wow. OK. I mean, the stock looks like it's trying to figure out which direction it wants to go. Though, as I did reference, it's one of only 5 tech components that's up year to date. I mean, it gives you a kind of story on where tech has been as the sector itself is down 20 some odd percent. Overall markets right now, Steph, how do we feel about this reversal today, the bounce, the bear bounce, if you want to call it that, in and of itself?
I mean, you can't ignore Apple, but you also can't ignore what Amazon has said, what Meta has said, what Alphabet has said, all about the hiring freezes or maybe even some layoffs. Apple is 7% of the S&P 500, so naturally it being down 2.2% for the day is going to have a negative impact. We are in a trading range, Scott. You and I have talked about this endlessly. The reason we bounced on Friday and then today and the last couple of days is because sentiment was so oversold. And earnings actually been pretty okay, especially the banks, and especially on the consumer side. Now, I know you're going to tell me that in 6 months the consumer can roll over. It certainly is possible. But right now, none of the companies in the bank sector. Well, I kind of think you're thinking that. I wasn't going to tell you that. Well, I kind of think like it's a natural thing to think about, of course. But for the time being, I mean, Bank of America today, I mean, they had the best loan growth in 3 years. There's going to be momentum that carries the day. Sure, investment banking was weak across the board. That's what we see in the markets every day, right? But some of these companies, many of these companies, have net interest income and net interest margins to help protect the other side of the business. I thought Brian Moynihan did an amazing job explaining that very thing. But let's just go back to Pepsi. They didn't see demand destruction with a 12% price increase. So right now, earnings are okay. So that's the good thing. And by the way, there's also speculation China is going to stimulate more. But on the other hand, you do have these issues with currency. You have the other issues with rates and inflation. So we're in this trading range, unfortunately.
Alicia, I mean, you look at a day like today, it is somewhat emblematic of how you feel about the overall market, right? With a head fake intensive environment.
That's right. And I'll just remind our viewers, the V-shaped recoveries that most investors got used to over the last 10 years with quantitative easing really only happened only very specific market environments and in liquidity environments, which is quickly being drained by the Fed. And these bear market rallies are very vicious because if you're short, you want to cover. And if you're long, you think you're all clear and you're buying. And they're very, very difficult. But ultimately, we don't think the data is bottoming quite yet. And I think it's difficult to buy into the quarter until we hear from the companies and some of the forward guidance here, because we do think it's going lower. And while businesses right now don't think we're in a recession, I think it's pretty clear that the Fed is ready to tighten until we get there. And so we think it's just too soon to call the all clear. Now, there are bargains out there that are great, but I think you have to be careful about buying the companies that are making their numbers only on nominal on the inflationary side and not on the unit side, because ultimately there'll be a price to pay for that as well.
But the bottom line, before I let you go, is that you don't think the bottom is in. So if that is, in fact, the case, how much lower do you think we have to go?
So I don't like trying to call the bottom, and it's a difficult game to really call the pivot. I'd say this. If you're thinking of a Fed pivot, it's far from here. The labor market is strong, and the Fed does not think it's going to cause a recession, which means tightening isn't planned. And even though there'll be some signs of softening inflation on the energy side and on the goods side, we now have to deal with sticky service inflation in housing, rent, and wages. That will be more difficult. So we do think that you'll get to ultimately a 14 or 15 times multiple on whatever earnings you get. Right now we're at 16 times on elevated earnings that are not going to hold as earnings season goes forward.